Well, let's stay with gold now. And after Friday's astonishing run, pretty much the only bright spots in the market have been gold bullion and gold stocks. Well, I'm joined now from Singapore by Grant Williams, advisor to the Vulpes hedge fund and author of the newsletter Things That Make You Go, He's also a confessed gold bug. So, Grant Williams, investors piling into gold, I think it's up about 4%. How do you interpret the great leap in the gold price?
Hi, Tiki. Well, it's interesting. I mean, gold's been reasonably unloved for a little while now, and we've seen the gold price fall pretty hard from 1900 in September down to the low 1500s, and people were starting to think it would slip below 1500 and perhaps go materially lower. What we saw on Friday was gold breaking out. It jumped straight through 1600 bucks. It's up at 1620, and after an $80 rise from low to high on Friday, for it to hold its ground and give back a couple of bucks is a pretty strong performance from gold. But I think the real story here, as you alluded to, is the mining stocks themselves. I mean, they've been beaten up terribly over the last 6 months. I mean, these stocks have underperformed gold by 30% in some cases, and yet now they sit there, with earnings of 10 times, with some of them dividend yields, 3%, which is better than a lot of the major indices. And people are starting to look at these gold mining stocks now, realise that they're incredibly oversold, and perhaps we could see a decent bounce, which we certainly saw in the US on Friday, and I think we've seen that follow through here in the region today.
Yeah, and in Australia, Australian gold stocks also have the advantage at the moment of the Australian dollar going down. So really, the gold price is looking absolutely fantastic.
Absolutely, and don't forget, the price of oil, which is after labour the biggest cost factor for all these gold mining companies. Oil is also weakening, and that just ties into the fact that gold seems to have decoupled from other commodities. We've seen oil going down, we've seen copper struggling, and yet gold is starting to break free. It's been perceived as a risk asset for the last couple of months, and it's been sold off in tandem as people run to government bonds, which personally I think are far less stable than gold. And now we've seen it start to react to that, and people are starting to move towards it as a safe haven again. And once that move starts, it could get very interesting from here.
That is what I don't understand about gold, how suddenly it can have moved from being a risk asset, and therefore you've had somehow this major correction as things have been getting worse and worse on markets, and then suddenly we reach a point where actually it's not a risk asset anymore, it's a safe haven.
Well, traditionally it always has been a safe haven. Even if you go back to the Great Depression in the 1930s in the United States, the best performing stocks by 400% or 500% were the gold mining stocks. And when the Dow lost 95% of its value, some of the gold mining stocks were up 600%. And so it's always been a safe haven asset, but yet we've had, in the last year or so, there's been a lot of hot money come into the gold market as prices have gone up. It's been the best performing asset pretty much for the last 12 years. So it attracted a lot of froth, and so we've seen that correct. People have profits in gold. They've realised those profits to offset losses elsewhere, and that's been a lot of the factors hitting the gold price. But now we're seeing, as people's panic returns, it's starting to find that safe haven bid again. And
are we also seeing some of the central banks actually moving into the market now and buying gold once more?
Well, interestingly enough, the World Gold Council recently have just moved the central banks from a source of supply in the gold market to a source of demand in the gold market, and that's very, very important. I mean, central banks have been selling gold every year. The Washington agreements for 5 years limiting the amount of gold central banks could sell. The last one expired in 2009. The IMF didn't sign up for the new one, and we've seen a lot of central banks now turn around and start to buy gold, significant amounts of gold. China's last report was in 2009, at which point they doubled their reserves in gold to 1,000 tons, which sounds like a lot, but it's actually not. It's about 2% of their reserves. And to compare that to the United States, who has 83% of their reserves in gold, it's an insignificant number. So central banks tend to move long and slow in the same direction. So if they have turned, which it seems like they have, they will be buyers for some considerable time to come and put a floor under this market.
And briefly, in addition to that, we've then got some central banks potentially throwing stimulus into their markets. And what will that do to gold?
Well, look, free money generally is normally a very positive factor for gold. It's certainly been that way through the previous rounds of quantitative easing, and I would expect similar. And particular as if the only answer these central banks has is more free money, I suspect gold's going to react very, very positively to that indeed.
All right, Grant Williams, thank you very much for joining us there.
Always a pleasure.
And he is a gold bug, I should warn you.